Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler, talking money and investing, along with Mr. Ira Work and Evan Barner joining me today. Right here. No, Ira, you're not going to get a golden microphone.
I should have one.
I know you think you should have one.
Well, my wife says I'm a legend.
In your own mind, right?
That's exactly what she
Exactly.
says.
I know how that works. Okay, so fellers, I'm sure we have some things to talk about today. All kinds of things to talk about today. I'm sure you guys have some topics. So I think the only one thing that hit me this week was the ESG. Latest dirty word in corporate America.
Oh, gosh.
Is ESG. Many companies no longer utter these three letters.
Well, I think that's right ahead of DEI.
Yeah.
Diversity, equity, and inclusion.
Well, ESG is right along those same lines. Following years of simmering investor backlash, political pressure, and legal threats over environmental, social, and governance efforts, a number of business leaders are now making a conscious effort to avoid the once widely used acronym. It's become a very, very big political football, number one. There has been, of course, lots of talk about how it just hasn't kind of panned out as an investment strategy.
Yeah, go figure.
What do you think?
Well, it's just like any of these. You always bring up the Tron stocks back in the 60s or 50s, and just some flavor of the day, or the .com in the 90s. Pets.com, whatever. And just because something is popular, or just because it has any kind of even political or cultural legs, doesn't mean there's any academic science at all behind that being an asset class.
Right. And so many things are called an asset class these days. And it drives me crazy. It was like that thing we did last week, or we were talking about that one, investing at various ages.
Yes. Yeah.
And then, of course, they had asset classes, and it still cracks me up. The rate of return on the commodities portfolios, and that was the better of the two.
Right.
It was still like 2% return.
Futures and
the futures was the 2%. Yeah. That's right. Yeah. That's right, Evan. That's right. It was the futures was 2%. The commodities was 0. Something percent per year, and yet they still have the audacity to call that an asset class from an investing standpoint. But ESG was this. I want to do good with my money. Just for those of you who don't know. When I invest, I am investing in a company, and I'm letting them use my money. And when I'm looking at ESG, environmental, social, and governance, I'm thinking that I'm going to do good with my money. But the reality of it is your money is not going to that company. Your money is going to somebody else that bought that company before you.
Right.
And they want to get paid as much as they possibly can. And there has been a lot of push to have these companies try to be more responsible, quote unquote, in environmental ways. And it says that, for some companies, the shift was, and we basically here, our stance on this show has been no.
Right.
Because you're actually causing yourself to break a rule of investing by doing this, which is diversify.
By not diversifying.
Yeah, you're breaking that rule of diversifying, and you're not diversifying. Exactly. But it says on earnings calls, many chief executives now employ new approaches. Some companies, including Coca-Cola, are rebranding corporate reports and committees, stripping ESG from titles. Advisors are coaching executives on alternative ways to describe their efforts, proposing new terms like responsible business. Wall Street, meanwhile, some firms are closing once popular ESG funds as the interest fades. Isn't it interesting how things change?
Oh, yeah.
As much as we had to fight against this and rail against this, And it was just one of those things we just seemed like we were out of touch.
Right.
In so many different ways.
Or we hate the environment or something like that. Yeah.
Right. And it was one of the things I pointed out over and over on this show. And I guess, every once in a while you just gotta make the point.
I told you so.
I told you so. I was trying so hard not to say that.
And you look at it and, we're kind of discussing that it's just out of favor, from the cultural conversation, and now the companies are trying to sanitize the terms. Mm-hmm. But they would only be doing that if they weren't making 30% a year because they had been environmentally conscious. I mean, if they were shooting the lights out, they'd still be tooting that horn, even if people weren't caring. But, clearly what is it? We talk about that's it's as dangerous as anything is the things that just ain't so.
Right. Yeah. And that is one of those things that was just, it sounded good. Right. And it's like so many things in investing, you have certain things that sound really good and we get pulled in on them. And just to walk back a couple of years, there were periods of time when energy stocks were in the news everywhere, and it made perfect sense that you ought to be interested in it until it didn't. Until it
proved that it didn't.
Yeah.
Okay, because it proved itself. That's why I wonder why all these people follow actors who advertise for certain products. Mm-hmm. I mean, I certainly couldn't be hired to act.
You wouldn't be talking about like gold or anything.
It doesn't matter. It doesn't matter what it is. I could not be hired to act because that's not my area of expertise.
Right.
But people believe actors that this is what you should be doing with your money.
Why?
Because
why is that?
Social proof.
Well, because they tend to be successful and they're constantly in your face.
They act like they know what they're talking about.
Right. But
in reality, in a way, they seem believable.
It's almost like familiarity bias. Really, it's like, well, I know who George Clooney is. I know who Taylor Swift is.
Morgan
they must
Freeman.
know what they're talking about. I think it's just like even knowing a company as a stock.
Yeah. And it's interesting because you talk about that, Evan. And I think that it's that trust.
Yeah,
I know people and I've heard them, and I think I know them because I've seen them so much.
Yeah.
And then they wouldn't mislead me because I know them. They wouldn't do that. And you might be right. They might not knowingly do it.
Well, if you follow certain shows, like for example, Blue Bloods, Tom Selleck has been on there now, I don't know, 20 years or so. So you see him every week.
Right.
And he's very believable as the police commissioner.
Mm-hmm. Mm-hmm.
So therefore he comes out now, and I think that's really a great role for him. But he is an authority on law. So now he comes out and he does an advertisement for reverse mortgages. And you say, well, there's a guy who follows the law and is leading the police department.
Yeah.
So therefore he must know what he's talking about when it comes to reverse mortgages. So I should probably check that out.
Yeah. You take that credibility and you move it over to a different area.
Right.
Yeah. Attribution error.
Ooh, that was pretty fancy.
There you go. Just thinking about the show, and when we were just speaking about actors and so forth in general, or public figures, and I'm not making a political or a judgment statement other than it will be interesting to follow that the people that are named in all these Epstein documents, how is that going to affect their brand value in terms of being a sponsor for a particular product? We saw that when Bud Light made a misstep that just tanked their stock value. It will be interesting to kind of follow if there's any fallout from being associated with that as a spokesperson for some product, whether it's a tennis shoe, a cola, makeup or whatever.
It just reminds me of Warren Buffett saying, it takes years and years and years to build a good reputation.
Yeah. Yes.
But minutes to ruin it.
Yeah.
Mm-hmm.
Yeah.
Yeah. I mean, I think that is so true, that it is so, and I think, that if we can get credit for anything around here, it is we are absolutely consistent.
Right.
In the message.
Yeah.
And I think that has been critical. And I'm going to tell you folks, over 22 years of doing this show, that has not necessarily been easy.
Right.
Because,
You've
have
been swimming upstream a few times.
Yeah. You have a lot of times where you are going literally against everything out there.
Yeah.
COVID. My goodness.
Yeah.
We were live. And I called all you guys in and said, let's get on the radio right now, and let's do this as a group. And we were spread out between these two rooms.
Right.
Remember that? We were spread out between these two rooms talking about what's going on, and the videos. I think back to I like to bring back 2008, December of 2008, as it's a holiday month. It's December. You should be relaxing.
Right.
And 32, 33 videos in a 31-month day. Educational videos telling people not to panic. Now, in this particular case, it's telling people, you look at the ESG type of thing, and you go, hey, and it was back, when you had Bitcoin was up at 70. And who knows where that's going to be? I mean, just
right.
But it was at 60-something thousand, almost 70,000, I think it was. Saying that it wasn't the greatest thing ever, seemed absurd.
Exactly.
And then it dropped back.
Well, we're just old fuddy-duddies. We can't get with the times.
Yeah. And it's easy to get pulled astray. So, that I think is really important to keep in mind. But, it's just one of those other things, political. It's going to be a year where you're going to hear a lot about this, I'm sure, because it has been a political football. There are companies that, when you get down to it, there are a lot of companies that are engaging in this. They're starting to back away from it to a great extent. Recognize that, they're mutual fund companies will do whatever they feel like they need to do. Unfortunately, whatever they think you want, they will give you. And, but it doesn't mean that the mutual fund company's bad. We don't look at them from that standpoint. We look at them from, okay, they provide something that we need. If they're doing some things, and I don't care, some of the companies that we absolutely think are just phenomenal from an academic standpoint have done stupid things over the years.
Oh, yeah.
So it's just watching out so you don't get pulled in, because fund companies are not, and I guess where I'm going with this is I'm thinking kind of aloud as where my mind is going on this. So often we watch advertising and we see that, we think that the fund company is your friend. You're an owner.
Of the fund company?
Yeah.
Yeah.
You hear those commercials. You're an owner. You'll see commercials that make you feel like that they really love you and they really care about you. The reality of it is the fund company has one job, and that's to sell you their product, whatever. And if you won't buy this particular fund that they've got, why is it that you'll have some of these fund companies? And one comes to mind that has, over 1,000 mutual funds.
At least, yeah.
And they have like a dozen of them investing in one area of the market, one section of the stock market. Actually, even more depending on how you break it out.
Right.
And then you go, well, why do they have so many different funds that invest in that one section of the stock market that has a limited number of stocks to choose from? Is it because they just love you and want to take care of you? Or is it because they have got to get you, the means justify the ends? They've got to get you on board as a client, and that's all there is to it.
Right. Well, and out of those 12 funds in this example, in that area of the market, one of them will do the best of the 12. They'll all overweight different stocks, and whichever fund did the best, that's what makes the cover of Money Magazine. That's what makes the ad in Wall Street Journal or whatever. And it attracts dollars because it did well that year.
But in addition to that, when they have let's say 12 out of 1,000 funds,
Yeah.
all focusing on a particular area of the market, even if they're all weighting certain stocks a little bit differently, the returns are going to come out fairly close.
Yeah.
So therefore, they can say, well, we had 12 funds that beat their benchmark this year. And that sounds very, very impressive.
Right.
That's true.
But they don't. But the general public doesn't realize, well, they're all invested in the same thing. So they should have had a return that was very, very close to one another.
Yeah.
And when you look at the fund company, like I said, providing a product, I mean, you think about it, it's like a grocery store.
Mm-hmm.
I walk in that grocery store, some of those choices just aren't that good.
Right.
But the grocery store isn't going to go, I guess there are some niche grocery stores that only try to do healthy products, but even the ones that only try to do healthy products have some things in there that aren't so necessarily good for you.
Yep.
But they got to get you in there or they're not going to stay in business.
And then again, what is a healthy product is going to depend upon the person walking into the store.
That's true.
Like, for example, I think beef and pork are very healthy products, but you don't eat those things, Paul.
Well, because when you have a cholesterol level of 300, it's probably not a good idea to eat that stuff. But it's if it
I eat your share. Don't worry about it. I eat your share.
Let me tell you, I will admit this. I only eat vegetarian cows. The cows I eat are vegetarians.
That's just ridiculous. That's just ridiculous. All right. On to invest. But, just to kind of the final thought in regards to the ESG and those types of things, just recognize that there are things that are going to come along as time goes on. And, the thing that I like to point out to people is there will be an emotional reason that just seems to make a tremendous amount of sense. You'll hear the media get behind it. You'll hear politicians get behind it. I think about some of the things that the government is pushing right now.
Yeah.
And they push them and you don't even recognize you're thinking, well, what is the government? What dog do they have in the fight? Well, let me just give an example. Roth IRA conversions.
Oh, yeah.
In some cases, they make a tremendous amount of sense. But the reality of it is if they can get you to pay taxes right now in the federal budget mess that they're in, they're going to get you to do that. What's another example? Well, another example would be insurance companies. And I've mentioned this before. Who is the biggest buyer of government bonds?
Right.
If it weren't the insurance companies.
Yeah.
So the government would say, hey, maybe it's not a bad idea to annuitize and we'll put annuities inside your 401k. We'll do these types of things because they know that what will happen is the more demand they create for these products, the more demand they're going to create for their bonds that they put out there.
Yeah.
And the less likely they're going to have because if there's lots of demand for bonds, what does that do to the price of bonds? It drives prices of bonds up and you create lots of demand. But what does it also do? It drives interest rates down.
Correct.
And then it keeps politicians out of hot water. So you think about it, there is no place that you can go literally when you don't have some kind of influence
Right.
that is against what is maybe in your best interest. And keep that in mind. And that's why I think it's so important to stay grounded in the academics when it comes to investing in the year 2024. And that's what we're doing all year long. We've been talking we were all talking amongst us before the show. And we were talking about the educational opportunities, the things that are coming along that I think in 2024 that we need to be looking at. We need to be looking at education funding. We need to be talking about things like what happens, what do you do when you have debt up to your eyeballs? Because the rules are really stinking complicated.
Yeah.
and we were laughing amongst ourselves. If this is complicated to us, what is going on with you guys out there? And
the ostrich effect.
Yeah, probably. If you're wise, just stick your head in the sand and hope it all, Calgon, take me away. Hope the world goes away. Make the world go away. Get it off my shoulder. So I think that's one of the things that we are going to be committed to in the coming year, as we always are, is continuing that education process. And how do you do that? The website, paulwinkler.com. You go there. You sign up to make sure that you're getting the emails when we put new workshops up there. Look at the workshop area, the tab there. We have webinar tabs there where we teach about Medicare, because most of the information you're getting on Medicare is driven by the investing or the sales of insurance industry, or people selling those types of things. Social Security. Where do you get information about Social Security? Well, a lot of this stuff out there are people doing these workshops that are, out there. You get a steak dinner and you learn about Social Security, and a lot of the stuff you learn is of marginal value, and it's really designed just to say, hey, come see us, and then we'll help you with your Social Security. We'll teach you a little bit about Social Security, enough to be dangerous. Mm-hmm. Then you come in and so we put out the workshops on that type of thing on the internet for free, so you can sit there and just watch that. Partially because it's just I like really irritating.
We're such nice guys.
No, I like irritating the companies who put this they put on those steak dinners, just by basically saying, hey, you can go out there and get the same information without feeling the pressure to buy something.
Yep.
Yeah, that'll show them. So we got a good little chart and a little story. Technically, it was last week, but the chart showed up this week.
Yeah.
Watching TV Monday morning. Actually, technically, it was Tuesday morning that I got the picture of the chart. But anyway, it was. But anyway, I think it was a good education on market efficiency. And when we talk about markets being efficient, we hear that it's like 80-90% of money is being actively managed. And you'll hear even people brag about their active management of investment portfolios. You'll see, stock movement between buying companies, selling companies, and more generally, you'll see like a tactical asset allocation where they're shifting money between different segments of the market. I think this is going to be in favor this year. I think this is going to be in favor the next year. I think this is going to be in favor based on what's going on in Washington, what's happening with China. You see that China is actually, with the help of Russia, has actually gotten the status of the biggest exporter of cars?
Well, actually, they sold more EVs than Tesla in the last quarter.
Biggest exporter of cars. Yeah.
Of any car or just electric cars?
It just said cars
Wow.
in general.
Okay.
Yeah. So, but back to my point before I just kind of diverted myself. I just squirrel. But it was my point I was making was about markets and how they price things, and how you might watch what's going on in China and think you're going to need to shift your portfolio based on what's happening. But the idea behind market efficiency is that things are properly priced based on things that we might know are going to happen or likely to happen, knowable and predictable events. And, one of the things that we do in a workshop that we teach at the very, very beginning is we have shown, like, there was a bombing at the White House. You guys remember that chart?
Yes.
And, there was a bombing at the White House. Now, it was a false tweet. False X. Now we would call that, right? But it was a false tweet. And nobody had bombed the White House, but somebody decided to put. And my wife's always asking this question: why do people do that? Why do they put fake information out there? And I was like, yeah, good question. I don't know, but people do, and you just got to recognize that they will do that. But here's what happened: the stock market dropped immediately. And you see the chart, it's like a cliff. It's not gradually, it goes down a little bit at a time. It's like not like a decrescendo. It's a bam, gone, down right away. Well, that happened with Boeing. And we hear this news story Friday evening. As many of us are, checking out the news Friday evening, we're hearing, oh my goodness, there was something that went wrong with one of the airplanes.
Right.
And, the cab opened up, and, thank goodness for people being in seatbelts, in the airplane. You wonder, why do we wear a seatbelt in an airplane?
That is an excellent ad for staying buckled up in your seat even after they turn off the light.
Yeah. I mean, because you think, why do I need to? And who'd have thunk, right? So then, of course, what happens is you can imagine yourself, you're an investor in Boeing stock, let's say that's in you're not doing what we teach, staying away from individual stocks, and you're an investor in individual stocks, and Saturday morning, you're sitting there looking at your finances and going, you know what, I think we ought to get rid of this because it's probably not going to be good for Boeing after this stock opens back up, right? It might be going through your mind.
Right.
And you go Sunday, maybe you're doing your finances or whenever, sometime during the weekend, you're doing that saying, I probably need to get out of this, thinking that when Monday happens, you can get out of whatever has happened.
Yeah.
And the reality of it is that chart looks like this. It looks like you're on this little, you're running on this flat ground, and all of a sudden there's a cliff. Boom.
Wile E. Coyote got to the edge.
Yeah, exactly. It's straight down. And what happened, it didn't gradually move from its previous price gradually down to the new price. It went from that price down to the new price like
in
bam.
Seconds.
Yeah, it was it. It was the opening trade. The opening trade was lower.
And you can't even place, like a stop loss or a limit order or anything like that over the weekend. I mean, you're just skunked until they open up.
You are done. Yeah, there's nothing that you can do. And I think that is a really good testament to how efficient markets are. They price the new information in immediately. And it may not be immediately because the market's not open.
Right.
Nobody's doing any trade. So we often will say that it's immediately, priced in, but it's not. It takes, when the market has to be open for that to happen.
Thinking about this and the bigger situation involved with this issue, it reminds me of when the Challenger had a problem.
That's a really good example.
And very quickly, the market kind of figured out, okay, it's Morton Thiokol and so forth, and we see all these stock prices. Well,
so for the people that have not seen our workshop on that, walk them through that slide, Evan.
Well, there's basically we've got a picture of the Challenger taking off and all of this, and it explodes. Video, yeah, and just in a matter of minutes, if not seconds, various stocks of the various contractors on the space shuttle start dropping, and the one that drops the most, the fastest, and all was I think Morton Thiokol, and they were the ones that made the O-ring that ultimately. After, a 2-year government investigation, they say, okay, it was the O-rings. And in minutes, while the smoke was still in the air, the market came to the conclusion it's the people that made the O-rings.
That is such an eye-opening video.
It really is.
Because you're naming 4 different contractors.
Right.
All of the contractors went down in value. Now, it may have been because maybe there's a possibility that the program would be shelved and they wouldn't be selling anything.
Right.
But, so that was only so they all had a minor drop in stock price, but it was 2% drop versus 10%.
Yeah.
For the one that actually was responsible for the O-rings. And nobody really had to come in. There were no investigations. There was no time for an investigation.
Right.
Minutes later, that drops.
But the similarity to this is Alaska Airlines. Their stock price dropped briefly on Monday. Already recovered back to basically where it was on Friday. And Spirit Aero, which is the makers of the fuselage piece that came unglued or whatever, their stock price is down about 10% as well as Boeing's, and it's staying down. And so just very quickly, the market can, I won't say assign blame, but they can come to a conclusion, this is probably who is going to be hurt by this financially and affect earnings going forward.
And it's interesting you bring that up because a book that has been going around, I won't even name the book because I don't even want to give them any kind of press whatsoever. But it was this guy basically talking about the money supply and that the increase in the money supply was greater than what he thought it would be, what anybody thought it would be, and blah, blah, blah. And he's saying, therefore, this is what's going to happen, and this is what I see coming in the future. And my basic response is, oh, you, one person, know more than everybody else. There was probably somebody that had some kind of a theory that it was something other than an O-ring. I don't know.
Right.
And they would have been dead wrong. But it was the general consensus of all informed people, not just investors, but people that were experts in the know. There was an economic incentive to get it right as to what was the part that possibly would have caused this problem. Mm-hmm. So that is market efficiency, and it's, again, proven itself to be a valid concept.